The Rebel Capitalist Show.
When you're talking about deflation, how are you defining that? Because when I hear people talk about inflation, deflation, it seems as though they just take this broad stroke approach, and there's a lot of nuance there that people miss. As an example, people think deflation, therefore they think the dollar is automatically going up on the DXY, that the prices of goods and services are going down and asset prices are going down. But what I've seen throughout the 1970s is a good example of that, is the CPI asset prices can be moving in different directions. And more recently, I've seen where the CPI and the dollar can be moving in different directions. So how do you define deflation?
You're right, George. We have to be very specific about what we're talking about, because deflation itself actually means something specific. And I'm as guilty as anyone for using it too broadly to describe exactly the stuff that you're talking about. But if we're talking about specifically monetary deflation, it's not strictly the opposite of monetary inflation. There are specific effects that monetary deflation have. If you go back to, say, for example, the early 1930s, that obvious monetary deflation, what that did to the economy was, because there was a shortage of money, it meant that consumers and businesses and all sorts of economic participants had to liquidate their own assets. Whether for consumers, they had to sell their own furniture just so that they had enough cash to buy groceries, for example. And what that does is it drives the price of everything downward. Because if everybody's trying to liquidate their own assets, not only does it drive the price of stuff down, it undercuts the profitability of production itself, which is the true insidious part of deflation, which means that when prices get forced so low because of monetary shortage, your businesses only lose money whenever they produce, no matter how much they produce. And the only way that businesses can respond to that situation is, as John Maynard Keynes said in the 1920s, they have to start cutting wages, or it results in mass unemployment. So specifically, monetary deflation ends up being mostly a labor market phenomena. So when you see mass unemployment and you see widespread wage cuts, which doesn't really happen as much anymore, but it does happen in certain circumstances, those are symptoms of monetary deflation. And that's what we're really seeing ongoing right now across a lot of the world. It's not specifically asset markets. It's not specifically what the dollar is saying or the treasury curve or things like that. But we're seeing massive levels of labor market destruction that, we haven't seen since the 1930s.
When we're talking about unemployment going through the roof, we're talking about the demand side of the equation. What if the government comes in with just this limitless UBI, let's call it, to pump up demand? I remember, I think I was talking to Lynn Alden, and she was saying that over the past couple of months, that average incomes in the United States have actually gone up because people are making more money on unemployment. So even if unemployment goes, let's say 20-25% like it was in the 1930s, if the government is just giving out all these stimulus checks, does it affect demand? And if it doesn't, is that still deflationary when we could see the supply side of the equation shrinking a lot faster?
Now, you have to go back and think about Friedman in the 1970s talking about, not just rational expectations, but the permanent income hypothesis, which says that if consumers or business or workers or whoever are getting stimulus checks, they will adjust if they're temporary. If they're temporary, they might splurge, but then they'll still be cautious and they'll still pull back spending. So what you might end up getting is a temporary surge in spending and income, but consumers are not stupid. They know that the checks are going to run out, and they're going to prepare for the day when the checks run out. And the way that they prepare for that day is by increasing their saving, which ends up being harmful toward economic activity. So, a temporary increase in stimulus is really, again, only intended to buy time for the private economy, the regular economy, to come back and provide consumers again with regular income, permanent income, that they can then count on to go back to the way they used to be before. But yet consumers know that these are one-time things, or they're temporary stimulus measures. And so they've already started saving. We see it in consumer credit. We see it in the savings numbers. Consumers are already adjusting their behavior because, look, they have to be realistic about what the labor market actually is. So even if you're not one of the unfortunate workers who have lost a job, you could still have a job, but be worried that you might be next on the unemployment line. That's going to change your behavior. You're going to react to that by acting very differently. It's going to reduce aggregate demand throughout the economy.
Okay. Is there a point where that psychology changes if the government says that they're going to make this more permanent? Or is there a barrier to them making it more permanent?
Is government payments under UBI the same as a job? That's really the question. Is it a good enough substitute where a consumer says, I used to be working and I used to get X number of dollars. Now I'm not working, but the government's going to pay me X number of dollars. Are those things actually equivalent? Do they make a difference in terms of behavior? And I would argue that the UBI or anything like that, while possibly a marginally useful substitute, is not a substitute for a robust labor market. Because a robust labor market isn't just X level of income, it's opportunity. It's the promise of greater and growing levels of income. It's a dynamic marketplace where it allows consumers to act in the way that the economy needs them to act. They can be reasonably assured that they're going to have, not just what they make today, but some kind of better future for themselves, and they'll act accordingly. That loosens the proclivity to spend.
Yeah, okay, that makes a lot of sense. So when we're talking about the destructions of deflation earlier in the 1930s and what Keynes was talking about, how should I look at the deflation that we had in the late 1800s, where we had, and from what I've seen, obviously the data is sparse to say the least, but from what I see, you've got like maybe a 2 or 3% deflation, but then you've got GDP up in nominal terms, you've got wages up in nominal terms, you've got interest rates around 4% nominal. It seemed like although we had deflation, we had a pretty strong economy. So is that a different type of deflation, or am I reading the numbers incorrectly? What do you think?
Yeah, I mean, you're right about a couple things there, starting with the fact that economists have argued over whether the Long Depression actually existed or not. And the Long Depression was really supposedly a result of the United States going back on the gold standard after the Civil War, reimposing fixed money supply at pre-war parity and retiring all the greenbacks that were issued to pay for the Civil War. And, I don't think there's really been a satisfactory agreement. I mean, both camps have really dug in pretty hard on their own respective positions because there simply isn't enough data to say for sure which one was the right one. Contemporary sources refer to it as a boom, while some actually do call it a long depression. So even what limited view we have of the situation on the ground back then, there really isn't an agreement as to what actually happened. And of course, the end result of the Long Depression was silver agitation, which suggests that maybe there was something to it. That maybe the money supply needed to be loosened because it was too tight. But the other point here is, I think the more important point is that there are different kinds of deflation. Monetary deflation, as we described it before, ends up destroying the labor market. Productive deflation, as we've experienced throughout our histories, throughout the history of the post-Enlightenment period, is not the same thing at all. Productive deflation is what capitalism brings through the mass production of goods. It's essentially that we get better about producing things, innovations, combining capital with labor in more efficient ways that allow us to produce more and better and products and services that increase the level of living standards by reducing the prices for a large majority of the population. So productive deflation is not at all the same thing as monetary deflation. In fact, we expect productive deflation as sort of our background behind everything. So, we have to be careful about making sure that we're talking about one or the other, not both at the same time.
Wouldn't that really kind of shine a light on the Fed trying to create this crazy 2% inflation target, if that's still their target, where we could have the economy improving, to your point, if we had the productive deflation, but then they're sitting there fighting this productive deflation. Heaven forbid prices go down so consumers get a break with more whatever they're trying to do to create inflation. Aren't those at odds?
Yeah, and far be it for me to argue the point for central bankers, but what they're actually saying is that, look, we can't tell the difference in a short-run scenario between productive deflation and monetary deflation. So therefore, what central banks intend to do is to actually invite a modest level of positive inflation to act as a cushion so that central bankers have enough time to sort out which is which. So that we have, sort of what they talk about is altitude. We We have a little of inflationary altitude between inflation and outright monetary deflation, so the central bank can have time to get its act together to forestall the worst kind with the monetary deflation. That's really all it is. Central banks and economists, because they can't sort out one from the other, it's incredibly difficult to do, especially in a real-time basis. That's really what inflation targets are all about. Targeting a little bit of positive inflation to get people to expect a little bit of positive inflation as a cushion against monetary deflation that is hard to spot. At least that's the theory. I'm not arguing for it. That's just what's behind the monetary policy objectives.